So tonight we're going to be talking about using the MT4 or the Interbank FX Trader 4 platform to manage multiple setups, strategies, and indicators. And what's funny is when I set up these talks, I obviously have to have some sort of description and topic, otherwise people have no idea what it is they're going to be attending. And I'll just go off on 17 different tangents. So the topic and the description keeps me in focus. But the bottom line is, really what I want to talk about here today is what's going on in the current market, how I am trading it, and where you can find my ideas and thoughts and setups on the market so that you can learn, obviously, from that. See what I'm seeing and glean whatever information you can from them. My goal during our time here together every week is not to make you a mini-me. It really is simply to make sure that you're getting some perspective, my perspective, and you can, after that point, figure out what it is that you want to do with the market, maybe with a little bit of insight from what it is that I'm doing from the market. Simple as that, I think that for every, it's interesting, is trading is about the only thing that I can think of where two people will do two opposite things at the exact same moment. You have a buyer who's buying from a seller, or you have a seller that's selling to a buyer. They're doing two opposite things at the exact same price, and they both think that they're right. I can't think of anything else that has that juxtaposition. Okay, so I think it's just as important to think about why you want to get long, and also think about why that other person at that moment is either getting out or getting in or getting short. What's the opposite action being taken from yours when you're getting in? So I leave you with that, and then we'll go through the rest of our discussion, because I want to have that in the back of your mind. Think about the other side of the trade. Think about the arguments and what that other person may be seeing, because it can act as a filter in many ways. So again, I'm going to be talking about my particular strategies that I'm using in the market right now. I'm going to be talking about the indicators that I'm using for the setups that we're looking at right now. So I really just want to get into current price action. And of course, as always, if you have any questions as we are going along, go ahead and type them in. We have about an hour here together, so I just want to let you know that the earlier you type them in, the more likely I am to be able to get to that question and answer it as thoroughly as possible. Okay? So if you haven't already, a couple things, as always, I want to share with you before we begin. And the first place I want to share with you is, and this is a great place to kind of start your education about the MT4, the IBFX4 version of MT4. I mentioned the last couple webinars that there is a new version as of mid-May. So for those of you that have not downloaded, and this doesn't mean an update of your prior IBFX4 platform, but the new version. Again, if you haven't updated since mid-May, head on over to the website, log into your account, download the new MT4, okay? And again, it's a May 11 build date. Once you've done that, if you are still looking for a little bit of guidance on how to navigate the MT4, the link that I just pushed through on the website, the link that hopefully you can see in the upper left-hand side of the screen, is the platform overview videos. There's a whole bunch of them, okay? And it's a great resource just to kind of get started, how to navigate just about anything you need to get started with the platform, all right? I think next month I'm going to get more into the one-click feature that's on this new platform version. I don't know how many of you have seen it, but I'm going to get more into it next month. We have a very cool, and I don't even know if I'm supposed to tell you guys this, so I might get into like giant trouble, but we have a very cool new, I won't even call it a tool, it's a whole new, I guess you can say, website feature that I think is going to be released on Monday. So that's what, the Monday's what, the 1st already? I'm trying to remember what Monday is. Monday's going to be, yeah, the 1st. So on the 1st, we have a very cool tool that's being offered, and I'm going to definitely spend a webinar on that next month. I wish I could tell you, but they will absolutely Donkey Kong me if I tell you. But suffice to say, for those of you that have been asking, Raghi, I want to see what you're doing and see when you're doing it and getting into trades and getting out of trades, and kind of as a way to supplement what you're seeing on the Daily Forex Trading Edge, I mean, this is exactly where we're going here. So Daily Forex Trading Edge, if you haven't already been there, check it out. Talking about my trades, the markets I'm watching. By the way, the Daily Trading Edge has a lot of the updates that I have once a day, and I really want to get to the point where I can update it maybe a little bit more often. I don't know if we're going to get there because simply just the back end, not that I need to bore you with all this, but there are, of course, compliance issues. We just can't slap any old article that I write up there, okay? But under the Daily Trading Edge, those are all my articles. Under market analysis, I have articles here as well. In fact, I just had posted yesterday an update talking about the crude oil inventory number. Again, that's under market analysis. Joining me on the market analysis tab is also another one of our contributors, and you can read what he has to say. Also here, his name is Brian Kahn, and he's another one of the contributors for Daily Forex Trading Edge. And Alex Douglas out of IBFX AU is also one of the contributors for the site. Okay, so a couple different perspectives about the markets. And this is, again, where you'll find a lot of my writing about what it is I'm seeing for that day. And it's usually a little mix of what I see the headlines are revealing, and a little bit about what it is that I'm doing in the markets. So this information here, I'm hoping to kind of click together with what we'll be offering come Monday. I'm just super stoked. I wish it was Monday so I could show you guys, but we definitely can talk about it next month. All right, so having said all that, for those of you that are still running the older version of the MT4, you will have to head on over to ibfx.com/tools/grab in order to get the tools that you'll see running on my charts, namely the grab candles and the 34 EMA wave. For those of you that have that mid-May build, it's already in your custom indicators folder, along with some of the other tools I'm going to be looking at today, including the power stats and the new version of the auto chartist. Okay, so let's get on over to the charts, because that's what I want to talk about today. And again, our topic is basically going to be, I have this fancy topic, MT4, multiple setups and strategies. We're going to be talking about how I'm trading the market right now. So we'll be covering all that, but we're going to get knee deep in the current market. Hopefully that will make for some questions and some interesting discussion. As always, we're looking at the quad setup, which is just my way of saying there's 4 charts on the screen. Now, for those of you that have dual monitor setups, you can definitely take a look at a broader view of the market. I don't know how many of you follow me on Twitter or Facebook. You'll know that I had a little write-up on CNN Money, and they featured me at my trading desk at home, which is where I trade from. If I'm not here in Florida, I'm usually at the mothership headquarters in Salt Lake City for IBFX, but most of the time I'm here at home in front of my setup, and a lot of people have asked me, I want to see your setup, I want to see your desk, and it's there in all its glory. And I say glory pretty sarcastically because that was an early morning photo my husband took on my iPhone. I texted the photo to CNN Money, and I thought, there's no way they're going to use this photo. My desk is a mess. I've got my papers everywhere. I don't even think my hair was brushed. It was probably an hour into my trading day. And lo and behold, there it was, basically headlining the article. So if you guys haven't checked it out, like I said, I believe I posted it on my Facebook and on my Twitter. And my Twitter feed, by the way, is built into the new version of the IBFX platform. So if you blow up the feature called IBFX Connect, let me go ahead and show you that. You can actually also follow me on Twitter, as well as Alex and IBFX. So I've got a chart here, right? I've dropped down my custom indicators sidebar. You can see all the different options we have here. And I actually need to go to my expert advisors, and you will see IBFX Connect in that list. Just drop it on the chart, and what's going to happen is your chart is going to become basically a web page. And it's going to load news, it's going to load a calendar, and also the Twitter feed. Okay? So you can check that out there. All right, so what's going on in the markets? Well, we can't really talk about the markets without talking about what's happening with the debt ceiling, can we? It's something that we are dealing with. It's something that has got the market on edge. Obviously, a lot of political posturing going on. I'm a trader. It's not about the politics for me. It's about the psychological reaction to what is happening, and we want to keep that in mind. We don't want to pick sides. We're not interested in anything else. Again, this is the trader, not the citizen, not the human, not the human side of our lives away from the charts. We want to keep a very unbiased opinion. I think a lot of times the bias of what we see in the world sometimes can make its way into our trading, and that's just exactly the opposite of what we want to do, because then we're in the melee with the herd. Okay, we don't want to be there. We want to be observing their movement. So when I take a look at what's happening, obviously the dollar index has been getting driven down lower. I mean, we've been seeing that movement lower on the dollar index. Today it had a little bit of a rally. Today and yesterday, I guess you could say. But as the dollar index loses ground, okay, in about, let's see, it looks like 1, 2, 3, about 4 or 5 sessions, basically from the 21st, okay, we've made it down from a high of 75.37 to a low of 73.58 on the dollar index, which is a significant move, okay. So when I look at that and what it's done to the euro, US dollar, when the dollar index is weak, okay, what typically happens? Okay, I know the euro is an odd example because of everything that's happening in Europe, but when the dollar is weak, what typically happens? It loses ground against the euro. You can see that happening here. We saw that move I told you from the 21st. The 21st is right here. That's this big green candle right there. That's the 21st. You can see the euro moving up. I've said it a couple different ways in a couple different places, and definitely a couple different times, that I think a lot of the euro strength right now is definitely a dollar index weakness story. That's what's driving it. That's my opinion. Okay. So it's not any inherent strength that I see out of the euro itself. It's the euro US dollar moving higher, driven by dollar weakness. And if that dollar begins to recover, which it has, last 3 sessions, you can see the movement lower on the euro the last couple sessions based upon the dollar's bounce and rally back up through the 74 major psychological level. Now, the euro is not necessarily a pair that I am wild about trading right now. Okay, you've got 2 large economies on edge. Okay, a lot of different fundamentals swirling about them, a lot of different ways these fundamentals are being interpreted. A lot of edge means a lot of volatility, and volatility means what? Risk. That would drive me to focusing on shorter term time frames on the euro. Those time frames would be the 5, 15, and 30, and looking for any kind of clarity in the market psychology that I could find. Multiple setups means I'm going to be considering, of course, multiple pairs. So as I'm going through the market doing my triage, part of that process, if you think about, again, where the word triage comes from, it comes from to sort. The word to sort in French is trier. Well, for me, that sorting is prioritizing, because if I think of triage in the medical sense, I'm thinking about, prioritizing people who need attention, medical attention, sooner rather than later. Okay? That idea of my attention being applied to a certain chart sooner rather than later will also come to when I might have to act on it. So when I consider all the lines and levels that I have on my chart, Fibonacci, pivots, chart patterns, major psychological levels, whatever it may be, if price action is near a price level that I will have to make a decision at, the chart has what I call proximity, or that time frame has proximity. In other words, I'm going to have to make a decision pretty soon. So there's a big difference between looking at, for example, let me show you an example of what I'm talking about. So I've been trading the dollar yen. I'm short the dollar yen, and proximity would say that the 4-hour chart here, when you're looking at it, I would have to make a decision to short this sooner than the decision I would have to make to short the daily. In terms of proximity to price action, to a decision level, my decision level on the daily chart, unless I'm going to put some sort of Fibonacci here to find a shallower bounce to short into, you guys know the sweet spot. I've talked about the swing trading levels I'll watch, and that is the 20-period simple being an aggressive level and the 34-period EMA low being the more conservative level within the context of this downtrend that I've identified based upon the dominance of the grab candles being red and the 4 to 6 o'clock angle of the 34 EMA wave. So again, from a proximity standpoint, from a triage standpoint, I'm going to have to likely give attention to the potential short on the 4-hour dollar yen before I consider the daily. So you got to work proximity into your triage. How soon will I have to make a decision on the different time frames? Triage in the total sense, though, means that I'm looking at all my pairs. Definitely looking at all my pairs, but looking at all the time frames that I consider, looking for the one that offers the most clarity. And when I talk about clarity, how do we define that? When I talk about clarity, we're really talking about market trends, and market trends really are revealing the dominant psychology on that time frame for that pair. Okay? We measure that with grab. We measure that with the 34 EMA wave. So I want to see organization in terms of a steady flow of either green or blue or red grab candles to show that there is an organization of sentiment and therefore possibly some organization of some sort of momentum. Okay, my 34 EMA wave is going to measure my market trend. So there's a criteria for clarity. It's 3 criteria, and it applies to the 34 EMA wave. This presupposes that I look at the wave and say that yes, it is either 12 to 2, 4 to 6, 3 o'clock, or 2 to 4. In other words, I can recognize one of my market trends through the clock angle of the wave. All right? And again, I'm assuming that many of you here in the room are already familiar with the way that I trade, the way that I use the wave, the market trends, the clock angles. Maybe that's an assumption I probably shouldn't assume, but in my mind, I'm kind of making tonight's talk more about some of the traders who have been following me for the past year, year and a half, follow me on the blogs, online, and so forth, and therefore I'm kind of gearing this in a little bit quicker pace, more advanced to them. For those of you that are new, okay, first of all, my apologies, because some of this, might sound like a completely different language, but you can head on over to the Daily Forex Trading Edge, and on the Education tab, there are a number of videos there, to the point that you'll probably get sick of hearing me talk. There's a lot of great content there, and you can play catch up in that manner, and then eventually you can come back to this recording and benefit from our discussion here tonight. So the clarity criteria, again, presupposing you've identified that yes, this is one of those clock angles. I recognize a 12 to 2 o'clock uptrend, or a 4 to 6 o'clock downtrend, a flat 3 o'clock for an accumulation market trend, or that 2 to 4 for that more volatile, wider ranging distribution market trend. Once you've got the clock angle, the first thing you want to look at is the smoothness of the three lines. Now, you're probably not going to get a smooth set of moving average lines out of the 2 to 4, but that's in many ways a hallmark of the 2 to 4 market trend. Okay. The next thing you're going to be looking at is how established is it? Has it just recently transitioned to this market trend, or has it been doing this for some time? If I head on over to that 240-minute chart or that daily chart, okay, you can see that the daily chart's been moving down lower for some time. The 240 also reflects. We've been moving down lower at 4 to 6 for some time. Okay, we've transitioned out on the 1 hour chart. You see that we were moving down, transitioned out. Okay, the final criteria in the 60-minute will be a good example for this, is what I call respect. Is there respect for the dynamic support or resistance of the wave? Now, in this case, because of the downtrend, we're looking for respect in terms of a kind of like a hand pushing down on prices, on bounces, on corrections higher. I want to see that the wave has been acting as resistance, that when prices trade up into it, they're met with selling pressure. And you can see that the respect for the 60-minute is not terrible, but we have pierced it a number of times, even when it was moving down nicely at a 4 to 6 o'clock angle. Okay? Within the context of that downtrend we saw in the 60-minute chart, take a look at this 30-minute chart. Do I have the smoothness here that I saw in the 60? No way. A lot more lump and bump to that wave angle. So it wouldn't even pass the first criteria of smoothness in the context of that downtrend. We lacked that smoothness. And by the way, this is a comparative process. Triage is comparative. You're having to sort. Sorting preassumes that there are more than one item in front of you and you're choosing. Okay? So that's what I want you to consider when you are looking at multiple pairs, multiple time frames, and you're having to filter through all these, look, if you're trading the 5, 15, 30, 60, 240 daily, that's 6 time frames. Let's say you're trading at least 6 or 7 pairs. That's 36 to 42 different charts that you are looking at. You must filter out, you must take away, you must cut away to only those time frames of those pairs that have enough clarity in the market trend that you can say, yes, I can identify the psychology that's ruling this time frame, okay? And therefore, I have confidence in the approach that I want to apply to it, because your approach, of course, and I say of course, but maybe this isn't that obvious, but your approach is really going to be a reflection of the market psychology. I'm not going to swing trade simply because I consider myself a trend trader, or I'm not going to momentum trade because I simply consider myself a breakout or breakdown trader. That's not the point. The point is to see what the market is doing and then respond to that right? And that's a concept that I think a lot of traders don't ever wrap their heads around. They find a strategy and they just start throwing it at the market. Well, the first thing you need to determine about that strategy is what type of market psychology is it meant to capitalize on. Trend trading's great, but not when there's not a trend, right? If I want to swing trade and short a bounce, if I'm not in a downtrend, I've got no business doing that. If I want to play breakouts or breakdowns, the market is not consolidating, coiling like a spring. Again, I'll be applying a strategy that probably has plenty of merit, but I'm doing it at the wrong time, in the wrong environment. I think that's where a lot of people become frustrated with individual strategies, because I think there are plenty of very powerful strategies out there that a lot of traders are teaching, but the missing element I've always found, and I say this because this was my frustration early on as I was teaching myself how to trade. My frustration early on was this. I've got a strategy, and I had pages of notes on it, examples of charts, but I can't ever recall in those early years when I would attend webinars or read books where someone said, use this in a trending market, and here's how you identify a trending market. So I went about finding a way to answer those questions myself, and that's what I'm sharing with you here. Your strategy must reflect the underlying market trend. If it's not, you're using the perfectly good tool, but for the wrong job. If I've got to saw a piece of wood in half, a hammer's a perfectly good tool, but it's not going to do the job that I need it to do. I need a saw. If I've got a bag full of nails, that saw is absolutely useless to me, even though in and of itself it's a perfectly good tool. Have I hammered this home enough? Because this is kind of my, and I hope that every time I speak, that's what I'm getting across to traders, that you don't have to necessarily trade the way I do, but I hope that regardless of what you do from here on, you're always asking yourself, what's the dominant psychology in the market? What's the dominant psychology of this time frame? And therefore, what is the strategy that's best applied to it? Yes? Okay, so again, if you have any questions, type them in. I've either put you all to sleep or I'm covering everything with absolute clarity. I doubt it's both, but if you have a question, please type it in. So in terms of the market psychology, the clarity on the dollar yen, again, as I go from the 5 to the 15 to the 30-minute chart, okay, and I'm looking at where I've got the clarity, again, smoothness, established, and the respect. I think that 240 right now and the daily would be where I'm seeing that clarity, that market trend clarity. Now it comes to proximity. In other words, which one is more likely to trigger a trade sooner? Well, that would be the 240. I'm not saying that you have to then trade the 240, but if you are trying to get into a short, and if you are looking at making a decision about whether or not you will, the 240 is going to present you with the decision level sooner than the daily will. Okay? So from a proximity standpoint, that 240 then kind of takes the first place, if you will, in this prioritization process, in this triage, in this sorting process. Okay? Now, I've been talking about directional bias a lot lately because in this environment, I'm finding that a lot of traders, because we've had such strong trends, but a lot of traders are so tempted to go contrarian. I'm sure there are a lot of very successful traders that are contrarian traders. I've never really heard a fantastic description of what that means, because in my experience, contrarian traders are often simply just top and bottom pickers, and I'm sure that's not a fair assessment, but I've never just really seen a reason to continually think a market is overbought in an uptrend or oversold in a downtrend without some sort of reasoning other than it's gone too far or it's breached a certain price level. You know, look, markets can go up technically forever. They can go down to zero, right? So unless we're at zero, we haven't found a bottom. and I certainly don't want to top pick. Okay, so are there times that you can trade trend reversals? Absolutely, and I think trend reversals are very different than trying to find a bottom in a downtrend or a top in an uptrend. Okay, so the reason I've been talking about directional bias so very much is because if I have to see one more tweet or one more comment about how the kiwi has gone simply too high, I'm going to smash my keyboard into something. It just absolutely makes me completely insane if I haven't got that point across. Nothing in an uptrend is ever too high. Okay, I don't want anybody thinking there's such a thing as too high or too low. Take that out of your vocabulary. Again, unless something is at 0, it is not too low. And there's no such thing as too high. How many traders have stepped in front of this freight train called the kiwi because it's simply too high? Well, if you look at the daily chart and you notice the directional bias has been printing steadily green candles since March the 25th, okay, of this year. Why would I want to think that I'm going to identify the top? Directional bias will then tell you, look, the dominant psychology is bullish. While there will be corrections, you're always going to be, in my opinion, of course, you're always going to be better off positioning yourself long at support within the context of an uptrend. Okay, let's take another market that people think is just simply too low. Dollar Swissy. How many people have stepped in front of this freight train in this misguided assumption of the market being simply too low? What is too low? No such thing. What is oversold? Within the context of a downtrend, again, no such thing. Overbought and oversold, by the way, has implications only in a sideways market. When the market's in a range and we can use a tool, an oscillating tool, my preference is a stochastic, to say, yes, within the range we're at the ceiling or floor, but there is no floor here. Okay? So at some point, are we going to reverse? Sure, but wouldn't I be better off when I've got such a dominant, organized bearish sentiment, bearish momentum, and downtrend? Wouldn't I be better off positioning myself at resistance? Okay? So that's why I want to start everybody off with this idea of understanding the directional bias of the market, because then it is absolutely going to help you with time frame selection and trade selection. Because when I do have a up or down trending directional bias on the daily chart, immediately I understand that there's certain trades that I'll be able to take short term, and there's certain trades that I'll be able to take long term. Let's go back to, well, we can stay here. Let's take a look at this dollar Swissy. And then I'll go back to the dollar yen. So I'm looking at this dollar Swissy. Directional bias definitely is down. When I look across the time frames that I may trade, short-term time frames to me are the 5, 15, and 30. So when someone says I'm trading short-term, have them define that. If I'm not defining what I mean by something, tell me so. Short-term time frames are either the 5, the 15, or the 30 to me. Longer-term time frames are the 60, 240, and daily. The 60 sometimes can kind of be on the fence, but generally speaking, that's where I draw the line. 5, 15, 30, 60, 240, daily. Those are the 6 time frames that I watch. Okay, those are my 6 views of an individual pair. And actually, 6 views I'll use in stocks and futures as well. So if I know my daily directional bias is down, I am not saying that we can't ever get long on the dollar Swissy. That's not my point at all, but we must then understand that it is a counter trend entry and therefore would be best limited to the 5, 15, 30. In other words, if I'm going to fight this freight train, I will do it on a very short-term time frame with the assumption that the organization, the bullish organization sentiment and momentum, will likely be short-term. In other words, a correction. So certainly, on a short-term time frame, can I get long as a market that's been in this healthy a downtrend corrects? We've had a number of corrections and some very large ones. I'll take advantage of getting long in a short-term time frame. Long-term, 1 hour, 240, daily, I will limit myself only to short positions because I don't want to put myself in a position to have to require a longer-term organization of counter-trend movement. Does everybody understand that? Directional bias will let me know what I can and can't do on the individual time frames. So I can get short across the 5, 15, 30, 60, 240 daily in this overall bearish directional bias, but if I'm going to go counter trend, 5, 15, and 30. Okay? So the daily chart sets the tone. Now, sometimes we'll have a market that doesn't really have a directional bias. Okay? And obviously I think the Euro-US dollar comes to mind. For a lot of traders, when they see this daily chart that you're going to see in front of you here in a moment, there it is. When they see this kind of chart, no clear directional bias. The market's moving in a lumpy bumpy 2 to 4 o'clock. We have a lot of wide volatility. I don't care how great the volatility is. I don't care how many fundamentals are swirling about. For a lot of traders, this will be a keep away sign. In fact, a chart like this, regardless of the pair, should come with a warning sign. When we do not, and my experience has been, when we do not have a dominant psychology in a pair, it's much more difficult to trade. Okay? It's much more difficult to trade. So when we have this back and forth price action that you see here, again, first of all, this could be keep away, but if you do decide to trade it, and sure, there are some opportunities here. I would never tell you that the Euro-US dollar is not without opportunity, but what I will tell you is you're probably better off focusing on the shorter term psychology because, again, why? There is no long-term dominant overall opinion of what's happening in the euro. Daily says so. So focus on 5, 15, 30, and that way you can take advantage of the short-term bursts, short-term maybe a few hours or maybe a couple sessions of organized bullishness or bearishness that's making up all these individual candles, so large candles that you can see. Okay, so there's some organized sentiment and momentum leading to shorter term trends, and those can be capitalized on by using 5, 15, 30s. Yes, so either it's a warning sign, leave me alone, or it's going to drive you down to those short-term time frames. Okay, let's head on over to the dollar yen. I know we had a question about the dollar yen. We'll cover that, and then I will head on over to the text window. And we'll take some questions. So directional bias. It's not as clear or as established as the dollar Swissy, right? But it is very much in a downtrend. So what does that tell me about the time frames? Counter trend would be a buy and should be limited to 5, 15, 30. I can go short across any time frame. All right, so right away I can filter my time frames. And maybe I don't want to be counter trend. Okay? If I don't, then I'll simply be focusing on going with the direction of the market, going with the flow, if you know, with the dominant trend. Okay? All right, so as I look at this, as I mentioned, you know, from a proximity standpoint, and my shorts, by the way, have been based upon the 4-hour chart. I mentioned that I'm short the dollar yen. My shorts are based upon the 4-hour chart. Okay. Since we're talking about the dollar yen, I probably should also throw into the discussion the bias on the euro yen is also down. Okay, when you take a look at the daily chart, also down there as well. This is another chart that I'm short on, and this one's actually based upon the 60-minute. The 60 in this case had the market clarity that I was looking for, and I ended up getting short on the 60-minute. I think the 30 did as well. okay? But back to the yen. I saw we had a question here, so let me go ahead and address this question. I already shorted the dollar yen on the 60-minute chart. Okay, you and me both. Should I get out of the trade since it is now sort of going a little sideways, or should I hang on to the trade until stop loss or profit targets hit? You know, I don't ever want to give anybody any trading advice from the standpoint of just get in or get out. However, let me at least paint the picture here, and then you can make a decision about that. First of all, my advice to everybody is kind of the cardinal rule that we're all taught about trading, which is never let a winner turn into a loser. How do we define a winner? Well, I'm not sure where you got short from, but at some point in that short, I hope there was a number of profit targets. Profit target 1, 2, 3, at least one for each lot that you have, one for each possible exit that you could have, okay? And obviously, we can break, using and this is one of the things I love about the IBFX4 platform, is I can get into 0.05 or 0.5 of a lot, and I can exit it in pieces. So I can turn even a small position into a number of individual pieces and exit a trade in pieces. And I love that because this allows you for multiple profit targets, because the sooner that we can say a trade is a winner, okay, from a risk management standpoint, the sooner that we can identify a price level in the context of a downtrend and call that support level an exit, a profit target. At that point, we can define the trade as a winner, and then we know at what point we will not let the market move against us, because that would, in fact, be letting a winner turn into a loser. We're told, that saying is as old as I can think of. I remember hearing that from the very first minutes of my teaching myself how to trade in books. Don't let a winner turn into a loser. But it is absolutely the most irritating thing in the world, because nowhere have I heard anyone say, well, this is how we define a winner. To me, we define a winner by that initial profit target, which is why it is so important that we do not get piggy on that initial profit target, because by reaching that initial profit target, we can begin our risk management process, which is trailing our stops. Okay? So whether or not you got short on the 1 hour or the 4 hour, again, I got short on the 1 hour euro yen. With that downturn on the dollar yen, I got short on the 4 hour. Sorry if I misspoke. But again, the whole point is to understand where your initial profit target is. Make sure it's based upon some sort of support or resistance. Again, that's my advice. And then once you've hit that initial profit target, trail your stop in, because your initial stop is what we call a risk-based stop, which means that if you had not ever reached your profit target and the initial stop you put in the market was hit, it would represent a loss of capital. But once you hit your profit target, you can trail this thing down into a break-even, which is essentially your entry price. Okay? Once we hit our second profit target, you can turn it into now a trailing stop. So it's very important that that first initial profit target be one that is realistic and not too greedy, because that's where your risk management kicks in. So having said all that, the entry, let's see, shorted at 77.97. Okay, so you shorted right at basically the major psychological level. So, you shorted just shy of that. Looks like it was not necessarily a wave or 34 EMA wave derived entry, but perhaps a major psychological level entry. Well, again, when we get into a level like that, we have to think about where the market's already gone, because I never want to assume that I never want to require that my swing trades require a new higher low. In other words, when I get in, I want to know that there's enough room to move that would substantiate the risk I'm taking to, in this case, the resistance that my stop loss should be placed just beyond, to the floor that I think the market has already reached, that I see the market has already reached. That floor here is 77.56. So I don't want to require a new low to make my trade work. I could get one and that would be great, but when I'm initially determining my entry, so let's put some lines in here. So our entry was 77, and thank you, Min-Ying, for allowing us to dissect your trade. Okay, I know it takes a lot of bravery for me to do this. Okay, so I appreciate you sharing that trade with us so I can not only talk you through this, but everyone else can benefit. So what I'll do is I'll put a teal line at where we got in, or aqua, where we got in. Okay? So the stop loss, we could cheat in a stop loss in this situation if we wanted to. Okay, we don't have to necessarily go to the opposite side of the wave, although we could, okay, which would basically put me right about there. Okay, and I'll put a red line there for my resistance. Where's that red? There we go. And then I can also consider a cheated in stop loss. I could use this recent high here, which would put me closer to the 78.20 minor psychological level. Okay, so that's another level I can consider right here. Okay, my floor was, we said 56, so I'd probably want to at least put it around 61, or 62. I don't want to expect price to have to dive below that. Consider the spread when you're getting out of the trade, and we want to put our stop, therefore, at a level that if 76.56 were to trade as support, I'd actually be buying it back at a higher price, which would put me at 61.62, right? Everyone follow? I hope. So look at my risk reward. It's pretty close to look at the distance between the aqua and either one of the reds and the aqua and the green. So just visually you can see you've got a 1-to-1 risk reward ratio. Now take a look. We've actually hit the low of 77.63 a number of times. What should that tell us? 63, 66, that if I'm going to get out, it's likely going to have to be around that area. I may not even see the 56 level again. All right. Now, in a bigger picture, one of the things we're dealing with is what? This kind of backdrop of potential yen intervention, which even if the rumor is put out there, even if people just have a fear that this is what's going to happen, the volatility to the upside could be tremendous. So there may not be that many traders that are willing to be in a significant way short and push to new lows. That's just one thing to consider. Okay? So those are the kind of thoughts that are in the back of my head that are fundamentally driven. This is what we've got technically. All right? So 55, while using the major psychological level for sure, was not necessarily respecting the fact that we bottomed out at 56, and therefore the support would be kicking in about 61, and we can see from the past few hits it's actually kicking in about 63 to 66. So I would tell you to go ahead and move that stop to say a 66, 67, 68, okay? And therefore, if we have another push lower, you can go ahead and exit there. Now, visually, let's move this up then. Let's move that let's move this a little higher. Okay? And I still think it makes the risk reward work. It's still a little bit, it's still 1-to-1, and certainly you could use that minor psychological level and that recent high, and it would definitely keep you within a reasonable risk reward. Does everybody follow? Does everybody have any questions on this trade that Min-Ying kindly shared with us? And I think that your trade plan was fine, Min-Ying. I think that the challenge here was the fact that the 56 was put in place. We have to respect that. We never want to be in a position where we have to get a new low in order to get our profit target hit, because that's then not respecting the support that the chart and price action has already revealed to us. Okay, we know that the major psychological level will be support, but the support's kicking in about 6 pips in front of that. So I need to respect that. Does that make sense? Everybody with me there on that? Hopefully that was helpful. All right, I got a question here about the cable. Did someone ask me a question about the cable? I thought I saw that there. So what phase would I consider the cable in right now? Well, let's head on over there. Daily chart, pound sterling, US dollar. And I actually would consider the cable now in a fairly fresh transition into an uptrend. We've had the dominance of the green grab candles, and even within this very shallow market memory, I'm only looking back to February. If I look back a year, it's even more steep. You can see that the angle is most certainly 12 to 2. But while we have the smoothness of the wave, we haven't really been tested in terms of support. So the respect criteria really hasn't yet been, it's really non-applicable here. So the smoothness is there. It's not really established. It's a fairly fresh transition into the uptrend. Okay, so yes, I do feel this is an uptrend, which means that if I want to get short, I'm going to limit that to 5/15/30, because short positions on the cable would be counter trend. Even though this is a very fresh trend, fresh uptrend, I do believe that the dominance of the bullish momentum and sentiment has turned this into a fairly fresh uptrend. So I'd be cautious about taking longer term shorts. Okay? And again, it's not like you can't take advantage of weakness. You would just limit those to shorter term time frames, because I think that positioning ourselves at resistance is a higher risk trade in this environment than positioning ourselves at support. Again, just my opinion. All right, but that's how I respect what the market psychology is telling us. Okay, and again, I'm using the green grab candles to gauge the momentum and sentiment. I'm using the angle of the wave to measure the trend. Okay. All right, so I've either just kind of left some of the newer traders or traders newer to my strategies in the dust, or been crystal clear, or everybody's catching a nap right now. I'm not sure which it is. Maybe a little mix of all three. But does anybody have any questions as we come into the final minutes of our time here together? And I'm going to roll over to my other desk and grab a swig of tea. I'm drinking some sweet rose tea tonight. Okay, so I got a question here from Tom. Thanks, Tom, for your question, who asks, I'm brand new to IBFX. Well, welcome. Running a demo account. Cool. How often do I run these webinars? Oh, every week, Tom. There is enough content on the Daily Forex Trading Edge in terms of past webinars. I'm here every Thursday. I guarantee you there's enough out there for you to get absolutely sick of me. All right, we run these every Thursday, 8 p.m. Eastern. I record these sessions. They're uploaded to the YouTube channel. They're uploaded to the dailyforextradingedge.com website. And at that point, you can basically definitely catch up on whatever you missed, and then when you join us live, like you are right now, with the other IBFX clients, we can have more discussions like this about the live market. All right, I got a question here from Mingying, who asked, do I agree that the short-term time frames have more noise, therefore a higher percentage of failure? No, and I think, and I totally understand what you mean, because in a volatile market, certainly movement on a short-term time frame, especially around an economic release, is much more dramatic visually. So in that regard, yes, because 5-minute economic release comes out, the candle is going to be much more dramatic than, say, the 240, where it may not even register. It might be swallowed up by the average pip movement. And when I mention average pip movement here, gang, this would be a great time to talk about the Power Stats plugin that's on the platform. And this will give you some insight, some forecasts into potential price movement based upon time and volatility. So in a succinct answer, do I agree with that? Generally speaking, I can understand certainly where that would come from, but I don't want to call it noise. Certainly there can be more volatility, but that has to be also considered at what time it is that we're looking at that chart, you know, and the price range that we're dealing with. I don't want to just say yes to that or simply no. I think there's a lot of variables. But I don't agree that there's a higher percentage of failure necessarily. Okay? I think what a lot of people do on short-term time frames is they forget the price movement ranges, that a 5-minute chart is not going to trend as consistently and as long as, say, a 15-minute trend would, or 30. So we have to gauge our expectations appropriately to the time frame that we're watching. Does that help? I hope it does, Minying. I completely understand where you're coming from, but I think the time of day, which session, the typical volatility, and economic indicators must all be factored into, or economic releases, I should say, must all be factored into that. Okay, got a question here from Warren. Warren, who asks, what is the best link or blog to learn how to use my wave? Oh, Warren, again, I direct you back over to the Daily Forex Trading Edge. I direct you over to the YouTube channel that we have, www.youtube.com/interbank FX videos. And those are also listed at the dailyforextradingedge.com. If you Google 34 EMA wave, you will come up with plenty of blog posts and articles and everything else that I've written. What you want to focus in on is look back, market memory, and then clock angles. That's really what you're looking for from a basic standpoint. And I do believe we have video on that, on basically the beginner's guide to the 34 EMA wave. Okay, thank you very much for your question. All right, so that is our time for tonight. Thank you, as always, for your, number one, showing up. Thank you. Keeps me from talking to myself, and I'm super appreciative of that. I love these discussions. I love when you guys ask these questions, and we can definitely get a conversation going. Makes it fun for me. And again, I appreciate your time and the questions that you're asking. So, with all that said, I'm setting up the webinar topics for August right now. If you guys do have any requests, definitely let me know. In fact, you can let customer service know, and they'll let me know. If you want to leave the request over as a comment on the dailyforextradingedge.com website, you can do that. If you want to let me know during our times here, hey, Raghi, in the future, can you schedule this topic? I will do it. I mean, I'm here for you guys, okay? So even though my cat looks fairly interested in watching the charts, I know I'm not doing it for my cat. So I'm doing it for you guys. So definitely let me know what it is you want to have discussed, and I'll do my best to schedule it in ASAP. Let's see. Got a last question here from Chad, who, oh, first time, okay. Welcome, Chad. Chad asked, this is my first time on your webinar, and I really appreciate you sharing your expertise. You're more than welcome, Chad. Thank IBFX, because they're the ones that let us do this. Some of the info was over my head, and I apologize for that. Hopefully some of the resources that I've mentioned throughout our time here together are ones that you can refer to fill in the blanks. However, the psychological explanations have been very helpful to understanding the framework. Oh, super, Chad. I'm glad that your first experience was a good one. I could not be more pleased. And again, for everyone else who's a first-timer out there, you know, we kind of rotate our topics. So you guys kind of reached me at the end of July, and I kind of wanted to have a webinar geared to my more advanced traders, and you You know, I know there's some of you here in the room that have to hear me talk about the 34 EMA wave one more time. You're going to bash your keyboard into something. So I try to respect that from time to time and have more advanced discussions here. But Chad, definitely we'll be having some more basic discussions next month. And for those of you out there that need some more basic discussion about grab and the wave, I aim to please. We'll be talking about order entry next month as well. All right, so I will see you all next week. We should have the outline going out tomorrow or Monday, but rest assured, we will have the registration available at the dailyforextradingedge.com website, and we will have 4 or 5 weeks in July. We'll have 4 or 5 fresh topics. 5. Wow, okay. Right? Is it 5? No, I'm sorry, August. What am I talking about? July. August. We'll have 4 or 5 fresh topics for August, and I will see you there and then. Okay, take care, everybody. Have a great night.